Happy Friday, dividend growth stock investors. It is November 22nd, 2024, and Colby the DGI Crab is here to take you through the list of the undervalued stocks that this channel focuses and emphasizes. If it's your first time here, I cover just 60 of the high quality dividend growth stocks that you could purchase on the open market to build passive income and build yourself up some financial freedom. I've split those 60 stocks into 4 separate categories based on the age of the investor, which in my opinion is the most important metric that an investor, especially a dividend growth stock investor, should take into consideration when making their purchases. There are plenty of values to be had out there in an all-time high stock market that's absolutely on fire. And we're going to go through each of the tiers today and figure out the best buys in each of those categories. Now, I'm not a professional financial advisor. The content of this channel should be considered primarily for entertainment, and the opinions expressed regarding investments are my own. You should always perform your own due diligence prior to investing your hard-earned money. So what is my personal strategy? The DGI Crab allocation strategy. Well, it's fairly simple, but I'll cover it here for you if it's your first time. Minimum of 50% of your new money will go into age-appropriate ETFs, so you get automatic diversification. I'm looking for stocks that are yielding 30% or more above their 4-year average yield. That's when they go into my personal buy zone. My top 10 favorite stocks, which are just separated out because I like them that much. And if they're just yielding 20% or higher above the 4-year average yield, I'll go ahead and pull the trigger and purchase those regardless of what age tier they happen to be in. I do still have one stock out of those 10 that's in that buy zone category. I'm remaining in my tier unless there is a stock in a different tier that's yielding at least 50% or more above the 4-year average yield. We got a few of those. And then finally, if there are no buyable stocks within my tier at a given time, I will just put more money into the ETFs for that given week or investment period. So that is the strategy, and off we go into the spreadsheet where I'll start with Tier 1 stocks. Tier 1 is for the age 18 to 30-year-old investor, where we're looking for lower starting dividend yield but very high dividend growth in the well above 10% if we can get it. And then we're sorting this by the valuation tab. Again, we're looking for 30% or more undervalued, which is comparing the 4-year average yield to the current day yield. Nike, after doing a dividend increase last week, is yielding above 2% and is still at the top of the buy zone for the Tier 1 stocks, with Nordson being a distant second. Nike would be the stock that I would be emphasizing in the Tier 1 category for the age 18 to 30-year-old investors. Now, the other stocks here, just so you know, I don't trade these things, right? So if I have a position in Broadcom and I bought it a long time ago and now I think that it's 46% overvalued, I'm not going to sell it off. I'm just going to sit and let the dividends reinvest and enjoy that win, but focus the new money into the stuff that is looking like it is on sale. So Nike for the Tier 1 remains my favorite. Tier 2 for the 31 to 41-year-old investors, we're looking for a little bit of a higher starting yield, 2 to 3%, high single-digit annual dividend growth rate. 2 stocks not only in the buy zone, but also above that 50% category. That is Hershey and Target. Target, at one point earlier this week, when they just took their massive fall from grace after reporting a terrible earnings report for Q3, was in the number 1 spot, but they've recovered a little bit. They were all the way down to 120. They've jumped back up to 125 in the couple of days that's passed since then. But pretty much neck and neck, Hershey and Target remained very undervalued stocks. Target, I was pretty happily buying it when it was in the 140s. Down here at 125, I do think it's a great deal. They're having a hard time competing with the likes of Walmart and with Costco right now. But Target, as I said in my video yesterday, is a dividend king. 55 years of increasing that dividend, 56 now. So I'm not particularly worried about them cutting that yield at any point in time, and these are stocks that I could get both yielding well above 3% starting out, and I think a fine purchase for whatever tier you happen to be in because they're above that 50%. Next, Tier 3 for the 42 to 53-year-old investors, Archer Daniels Midland and Hormel continue to occupy the number 1 and number 2 spot in this category. Archer Daniels Midland just can't get out of their own way. That stock price continues to really have a hard time this year with their maybe potentially shady accounting practices that they're trying to clean up. I'm not worrying about them cutting their yield at all. They are yielding 3.76% at the here at the close of the market, and I think that this is just a really great deal. You buy companies when there's bad news because that's when you get them, when they are on sale. Hormel had fallen down south of $30 a share. I really don't get it with Hormel. I can't seem to point my finger on exactly why that stock is not recovering. I really think that it is one that ought to be more in that $40 range. It has a 4-year average yield of 2.58%. Now, this 4-year average has continued to just gradually creep up over the last few months, but still, it still looks to be a very good deal. If you ask me, consumers are being very selective and very choosy and price conscious about what they're buying. And perhaps Hormel is just feeling the brunt of that. Do you have any opinions on why Hormel is having such a hard time recovering? Any interesting insights you have to share with me on Hormel that maybe I ought to be aware of? Leave it down there in the comments below. I'd be happy to hear your thoughts on it. Pepsi is one of my top 10 personal favorite stocks, and this is one of the 10 that if it hits the 20% or higher above their 4-year average yield, I jump in and purchase it, which I did again this week. It's only at 21.6%, so it's not well above that, but it certainly is within my target area as far as that is concerned. Johnson & Johnson, I thought might get into that range this week. Pharmaceutical stocks are dropping. From what I understand, it's mostly due to concerns about what Robert F. Kennedy Jr. might do in the Trump administration when it comes to regulations on big pharma. But for right now, Johnson & Johnson this week anyway held steady in the mid 150s. So I'm just being patient on that, waiting for a little bit better of a deal before I add to Johnson & Johnson. Tier 4 for the 54 and older investors, where we're really looking to get higher starting yield, but not throw dividend growth rate totally out the window. We do want the dividends to continue to grow and at least keep up with ordinary years of inflation. When you're at the point where you're no longer reinvesting your dividends, you're actually cashing them out and living on them in retirement. Realty Income is far and away the best deal in this group of 10 higher yielding stocks, but is not at that point where I'm ready to just jump all in on it just yet. I would like to see Realty Income get a little bit cheaper. It's an excellent stock, and if you wanted to start building a position in it or add to a position that you already have, it's not as though it's overpriced right now. 4-year average yield of 4.74, currently yielding 5.5. But again, when it comes to these single stocks, there is more inherent risk when you are investing in an individual company. So when I'm putting money into an individual company, I really want to get that at the best price that I think I could possibly get. And I'm very willing to just sit back and be patient and just add to ETFs in the meantime if it doesn't look like there is a deal to be had there. I do like to just quickly swing by this top 10 tab. These are my 10 personal favorite dividend growth stocks. These are the ones that I will buy when they hit that 20% threshold. As I mentioned, Pepsi was already there. Johnson & Johnson in number 2, McDonald's number 3. I certainly wouldn't mind McDonald's dropping a little bit more and adding to my McDonald's holdings, but it is going to it's going to have to dip just a bit more, quite a bit more actually, before I jump all in there. Everything else is either fairly priced, like Union Pacific or Coca-Cola, and the rest of the stuff to me just looks like it's still a bit overvalued from what I can tell. So what the strategy would look like, I break it down by percentages here to make it as straightforward as possible. As I said at the top, I do 50% at least of new money goes into ETFs, and the other half goes into stocks. This is sort of how I break down the different tiers in the category. For tier 1, the main emphasis would go towards the S&P 500, which is VOO, and you could swap out a different ETF if you've got an alternate that you like better, but I like S&P 500, small cap value, little bit of dividend growth, dividend appreciation, and 5% into international stocks. VYMI is the only international holding that I have. It is, I believe, the best ETF for international dividends that you're going to find. Tier 2, it's the same 4 ETFs for me. I just emphasize what I lean into the heaviest differently. So I'll do dividend appreciation the most, followed by S&P 500, little bit into small cap value still, international. Tier 3, more dividend-focused ETFs like VYM, SCHD, DHS. These are my 3 favorites in that category. You could do a little into all 3. You just pick one and focus on that one, but I really enjoy all 3 of these. Very different strategies, all excellent options. And then for the tier 4, I still want to do some stocks, so I like the straightforward, simple approach of SPYD. And then I also like alternate investments at this point in time where you can start looking at high yield bonds, preferred shares, MLPs, covered call ETFs, my 3 favorites in the category, Devo, JEPI, and SPYI, and then of course international again. And this is how I would break down the stocks on that side of it. So for tier 1, I do a 35% allocation into Nike, continuing to build up that position. Like I said, with tier 1, you're probably getting starting yield in like the mid ones a lot of the time on average. With Nike, you get something that starts out yielding above 2% right off the bat. And then because we've got 3 other stocks in between tiers 2 and 3 that are in that 50% or more undervalued as well, Hershey, Target, Archer Daniels, Midland, I do 5% into each of those 3. And just gradually start building smaller positions in those, and take advantage of getting the green light from this crab to buy a higher starting yield than you might typically be buying with that group of tier 1 stocks. Got the same 4 here for tier 2, but it's just the allocation is going to be different, where the larger percentage of the allocation is going to go to Hershey and Target. Again, staying within the tier and emphasizing those. And then also a little bit of Nike, a little bit of ADM. In tier 3, it would be ADM 20%, Hormel 15%, and then Hershey, Target, Nike at 5% each. And at any point in time, if some of these really undervalued ones to you feel like they feel too risky, if you're worried about Nike or you're worried about Target or whatever, I think Pepsi is a fine substitution there. Not as cheap as some of those other ones, but such a strong company, and it's probably not one that you're going to see in that 30% or more undervalued very often. So if you want to build a position in a real blue chip one like that, sometimes you've got to pull the trigger at 20. And then for the tier 4 group, look, since there wasn't anything in that category, again, week after week, I've just been emphasizing no shame in just doubling down on the ETFs. So if this is what your allocation strategy looked like, instead of 15 into this, you do 30, 5, 10, instead of 5, 10, instead of 5, 10. Very simple. I would still keep the international at 5% and just take that little 5% overall that's left over, pick your favorite deal. That could be Pepsi, could be Archer Daniels Midland, Hershey, Target maybe. This week, my gut just tells me grab the highest yielding one that's in that 50% or more undervalued, and ADM hits that just barely. And then finally, the DGI portfolio. I showed this a little bit earlier in the week. I missed on Target because I made my I did my DGI investment on Tuesday, the day before Target crashed. So I didn't add to that Target position, but this is what was added to Hershey, Nike, Pepsi, ADM, and then the 4 ETFs, which added $2.54 of forward dividend income on $100. So that's all there is to it, you guys. Email me questions, dgicrab@yahoo, and I'll see you next time.